Hi everyone, so today we're going to discuss a little bit about our 4 products, Days, Dingo, Dally, and Daryl. We're going to talk a little bit about our 7 decision rounds and how they affected our progress and our performance of each of those products. We're going to dive in a little bit about our research and development, our marketing, production and HR, finance, and our total quality management.
In each round, our group managed 4 different departments within the company. The 4 departments are research and development, marketing, production, and finance. In the research and development department, we chose what products we wanted to invent and how high or low tech they were. In our marketing department, we would set the price of each product along with our promotion and sales budget. In our production department, we control our plant size and our automation levels. Lastly, our finance department. This is where we would make sure all of our operations were funded. We would also raise money for our company.
Hi there, this is McKenna Hickson here to discuss the successes and weaknesses of our company Dibgy. We did finish 3rd overall in the capitalism simulation. So I just want to go over the first 3 rounds and what we did and what we learned to do in the next round. So on round 1, we realized that we had a strong potential in the low-tech market with our first product. Days was right on target for consumer price expectations as well as the reliability of the product. The tactic was to heavily invest right from the start just to get our product out there and allow customers to be able to find it. Sales and profit were getting higher because of this, and it paid off with an 86% awareness rate. We took an overall cost leadership standpoint into the low-tech market, and this was giving us a larger consumer pool as well as a lower price, attracting more customers. We surpassed the potential sales we stocked out on our first round. Going into round 2, round 1 kind of gave us a great start and a good amount of cash flow for future investments. So year 2025 is when we introduced our product Dingo, and we released this into the high-tech market. We knew we could have success in the low-tech market, so we just decided to see how we would do in high-tech. Dingo was able to stock out, only needing a few adjustments. We were in the area of the price, but needed to adjust on our size and age. The lack of investing into the sales and promotion budgets was where we had a weakness with Dingo in this round. So that was noted for round 3. We did not have a super high accessibility rate. It was around 66%. So customers really didn't know too much about it, so we took note of that for the next round. We added employee training hours for more efficient production. We issued stock to help with those investments. We were putting more into training our employees and recruitment hours. And our profits were over $5 million for the end of this round. And our closing cash position was above $2 million, so that led us into having a good start for round 3. So in round 2, we ended strong and decided to add another product, Dally. We focused this one into the low-tech market, as that's where we had our most success, and over the first 2 years, Days had continued to produce. So Days had continued to bring in this success, and majority of the profit in that was giving our investment money to put towards other products and continue to build up Days. So we used that into turning to automation. We did this mostly on our high-tech product, but we did do a little with the low-tech. So we also increased the training hours of 5 hours per employee and upped the recruitment budget for 1,000. Higher skilled employees are more productive and they are more efficient in creating a product quickly and as efficiently as possible. As far as the perceptual maps go, all of our products were set up for success going into the next few rounds. We had to make a few adjustments as far as the age and size go, but we were set up and had a profit of over $8 million.
Going into round 4, we wanted to make specific changes to our production ability, and we did so by increasing the amount of capacity and the production order for Days, Dingo, and Dally, our 3 products. In addition to doing that, we made changes to our product production. We adjusted our promotional budget for our new product, Dally, in order to generate sales in our new market. So this is going to be our results from round 4. As you can see, our low-tech product is far ahead of our high-tech product. However, we're keeping consistent market share with all the other companies and competing in that space, which is nice. So Going into round 5, to start off round 5, we issued $7,000 worth of stock in order to introduce a new product line as well as increase performance on all products, decrease production. We reduced capacity on Dingo and increased capacity on Dally. With these changes, we're hoping to achieve a more accurate number on the amount of products we will need for some products and try to stay ahead of production on our more popular products. So these are going to be our stats for round 5. As you can see, making those changes really affected our high-tech product and really increased the amount of ability and market share we were able to do with our low-tech products. We're still keeping a consistent market share and competing with the other companies. Going into round 6, we started by retiring $4,304 in stock. With this and the profits from our previous round, we increased our sales and promotional budgets for all of our products in order to ensure the most amount of sales leading into the end of the rounds. In addition to these changes, we also doubled the amount of training hours for our employees would be receiving per year. Finally, we invested in the automation for the next round in order to ensure the best possible outcome for our company's final round. So these are our results for round 6. As you can see, we just still stayed pretty consistent with our low tech product and how it performed in comparison to our high tech product. But still pretty consistent across the board, just at 30% of the market share.
As we trace Digby's trajectory through multiple rounds, a narrative of tactical evolution and sustained growth comes into focus. The financial reports in each round shows Digby as a formidable player in the competitive landscape of low-end products. With a precise approach to managing assets and liabilities, the company is positioned as a stable entity in the market. Prudent management of assets, including cash flow and inventory, underscores the company's financial stability. The balance between short-term obligation and long-term investment speak to Digby's foresight. Yet Digby's success is not confined to financial prowess alone. It extends to the core of the operation. The company was consistently demonstrated an acute understanding of consumers' demand and market trends. The product portfolio adjustments to each round showcases an unwavering commitment to meeting customer needs efficiency. Investors looking for a resilient and growth-oriented company should look no further than here. The consistent focus on the low-end partner segments, backed by a robust financial performance, will instill confidence among stakeholders.